This looks bad, Harris. We're probably going to have to amputate it.
I'll get some 3D images to see how bad it really is.
Your career's over.
What's that? We'll be fine. With my assistant, you can access the Travel Investing Review considers fund investment objectives, risks, charges, expenses, and more. Prospectus at invesco.com.
This is the Real Housewives Quick Fire Challenge. Today you'll make a dish featuring the famously slow simmered Rayo's homemade marinara sauce.
I'm gonna eat this.
Your time starts now. Stilettos or bad idea?
I bring the fight to a quick fight. I'm cooking seafood pasta with marinara sauce made with tomatoes grown under the Italian sun.
I'm boiling water for the highly reported peeling and heating up marinara sauce.
You're doing good.
3, 2, 1. And here it comes. Let's go, Jack.
Okay, I'm gonna set up here at the camera.
The complex flavors perfectly complement the sauce.
This is on, yeah.
Well,
I'm gonna eat this.
chic is my special.
What the fuck? Frozen here? Ah. There we go. All right, what's up, everybody? Am I on Twitter? Yeah. See here, I can barely see what if I get power another month. Trump's gonna send over a hitman another month. All right, I won't be too long today. I got a stiff neck, broken neck. I probably won't be able to see your comments because I can't really bend over. I get electrocuted with pain. So annoying. But I'll just breeze through some of the stuff here that we kind of been talking about. Well, last week specifically, more so than any other week. All right. And chit chat a little bit about the flow, more so, going into earnings season. So it's kind of on everybody's eyeballs right now. You had Netflix report. I'm sure the numbers were pretty decent. Stock doing anything? Yeah, up 40. This thing's already right off highs. Kind of a little slowdown recession hideout as well, this Netflix. But, on its own, I don't know, how much upside without any help from the market. This thing's already pretty expensively priced. All right, let me get to the overall market here. All right, so rewinding kind of where we left off last week, we had gone through several of the indicators and signals we pay attention to, especially into corrections, and we discussed how, what we kind of were trying to be patient and allow to happen in this pullback has happened. And, there are a few things here left that we would like to see, right? That we spoke about, fund flows being one of them. Kind of want to see retail maybe spit it up before we conclude. And I think more so, and this is what we could talk about today, I think what's left to be done here is kind of the spark on the other side, right? I think as far as the selling, the supply that we wanted to see come and hit the market, come out of the market in a sense, the froth, I guess you could say. That job has been done, right? And I think now, because of where the economy stands, especially off what the Trump party has done here, tightening things up a bit. You got financial conditions. The economy has tightened up. Not much of any growth out there. Not a whole lot to get excited about, and that's usually the case. All right, if you remember, we used 2018. We talked about as an example. What ultimately ends up happening is you get a boost, you get a kick in the rear end from Fed policy, right? Things get tight, the economy tightens up, liquidity tightens up, and the Fed gets involved to try to, kind of grease things up a bit, loosen things up a bit. So in late 2018, that kind of happened all at once. You had capitulation, and that kind of forced the Fed to react. The Fed react, and you pretty much had a V bottom. Okay, so it went from ugliness to now you look through the ugliness, cause now you got a Fed on your side, and obviously that's going to get you through the ugliness. Without the Fed, it's really difficult for funds and players to look through the ugliness, right? Because there's likely more pain that you're going to have to deal with. And even though we're at a place on the positioning side of things where things are a lot cleaner, in other words, a lot of what needed to be sold has been sold, the upside is kind of the difficult part, right? So as opposed to late 2018 where you had everything kind of come together at once, if you use 2022 as an example, it was different, right? You had positioning get washed out. You had everybody bearish, everybody looking for a recession, pretty much into the summer of 2022. And you really didn't get an all-out major Fed pivot, right? You had first they stopped tightening, right? So that was a major step because the UK bond market was kind of snapping. And then you had kind of SIVB, the regional banks, they cracked, and you had more, Fed-induced fiscal, whatever it was, liquidity stimulus, okay? So it doesn't have to happen all at once. It's nice when it does. But right now, we got to take what the market's giving us and play accordingly. And right now, I guess the best way to put it is we're in a really good place. I think positioning-wise, like I said, we have fund flows, a couple little things here and there that we would like to see to really, really put in a nice floor here we can play off of, in a sense. And then, a Fed pivot. Now, a lot of people, the Fed doesn't have to cut rates. It doesn't have to be a rate cut. It could be just some form of a liquidity, whatever, the QE, non-QE. Yeah, I'm no Fed guy. So I think that's what we got to kind of keep an eye out. And this is what we were talking about last week. I think we went from, listen, we're getting jumpy. We are fortunate to be in cash while the market is correcting. We don't want to jump the gun. We want to remain patient, let everything happen, right? I think the change in tune for us, the pivot for us is that's already done. All right. So now we want to start to lean constructive. We want to start looking for constructive signs to get long. And even though, again, if you use 2022 as an example, okay, because especially if you don't think the Fed's going to react or get involved in any sort of fashion over the short term here, it may play out something like a 2022 where you get a floor put in, may get tested, right? Even like the summer 2022 may breach it a little bit, but kind of the bulk of the damage has been done. And it's just the excitement to the upside, right? The start of a new bull trend that you're more concerned about. But that's not a bad environment. That's actually a perfect environment to focus on what a lot of you guys were getting antsy over, longer term tuck away investment / leap type positions, right? And I think, I don't want to get too jumpy because I'll show you guys some of the updated signals here, but just kind of the feel I get from people in the steam room, and I guess social media is a bad example, but they understand that. Okay, they want to do that. They want to start nibbling at longer term positions and nibbling at names into any weakness, trying to take advantage of that. But at the same time, if a stock doesn't look good in a week from now, they're stopping out or they're frustrated. In this, if you're taking that approach now and you're looking to take advantage of any additional weakness to start piecing into some stuff that you like longer term, you don't want a rally. Okay? You want stability. You don't want a V-shaped recovery. Okay? Because you're not going to get your hands on much. You understand? Like, for those V-shaped rallies, you have to be quick. Right? You got to be ready to pounce. That's a completely different ballgame. This, for kind of what we're dealing with right now is you want to take advantage of days where, everybody's shitting their bloomers over what Trump said or did. The market's down, and you're seeing some longer term buying in a name you like at a really huge discount, right? Or you sold a lot higher last year. And you're putting on, 1/3 or 1/4 of that position, or a name you had interest in, on the investment side of things, right? Tucking away a little equity or leaps longer term, and you just want to tuck it away and forget about it, okay? And you kind of want a dollar cost average into a correction, a weakness. That's what I think. That's where we're at right now. And again, I could be wrong. I don't like to put much of an opinion when it comes to this stuff, especially when explaining it to you guys. My opinion's not worth much more than any of yours. But things can change quickly, right? Whether it's something the Fed does, something can crack in the economy that gets the Fed to react. Maybe it's something that the White House does, right? Me personally, I don't think it would be like. Don't get me wrong. I think tariff related would get a big squeeze going, but I don't necessarily think that's what's getting in the way of that new bull run, right? I think you need either more of just time in a sense or something to get excited about, right? Like economic growth or a new facet of AI or something that shows up. So you want to keep your eyes open for that. You don't want to let the dull tape and more so the negativity out there distract you from paying attention and looking out for constructive signals here. Right? Now, again, there's no certainties, right? It could all fall apart. China can go into Taiwan next week and invade Taiwan, and you got a whole new shitburger on the table. That sets off sparks across the globe. I think the difference now here is that where we're at now, okay, even if there's more, no one has a crystal ball, even if there's more additional negative news here, you're a lot closer to getting the Fed to react here, right? A lot of that froth, that all sides positioning from systematic funds and all that, that's all gone now. So you don't get that snowball, that cascade of selling. A lot of times what you'll see is selling overnight and they end up buying that, right? You see a recovery. So that's the major difference, and that's where I think positioning provides an edge in paying attention to. Right? If on the flip side, if you're coming with all sides positioning and something goes haywire, things can get really, really ugly extremely fast. Okay. So that being said, let's go. I think this is the perfect note. I wanted to hold on a second. I think this is one of my favorite weekly notes from Deutsche Bank, and I think they touch on it all. So let me find that here. Hold on. What's today? Today's Thursday already. Holy shit. Hold on. Excuse my French. It's over here somewhere. Oh, wait. You know what I'm going to do? I'm just going to. Oh, here it is. Here it is. I'm going to pull up the whole note so we just look at it here. I could blow it up. All right. So you see a million different sentiment indicators, positioning indicators out there, from survey measures to options measures to you name it, right? Fear, greed, million different types of indicators. And, some may be flashing green, some may be more neutrals, right? You get different reads sometimes. We had to deal with that a lot, especially in the last few weeks into this correction. They weren't all there. What DB does, they put a lot of those key measures into one consolidated positioning indicator, which is this right here. So if you kind of want an overall view on sentiment, flows, and positioning all wrapped up into one reading, this is, in my opinion, as good as you're going to find it, as close, as accurate as you're going to find it. Okay? And again, this is more of a big picture read, right? These minor pullbacks, you're not going to get there. You're not going to get there. And this thing, if you remember, took some time to get there. We finally got there this past week. All right, and when I mean there, I mean down into this lower end of this range here. And you can see, the 2022, that double bottom I keep referring to. You were down here for that. COVID crash, obviously you were down there for that. Late 2018, we're actually even lower than we were back then. 2015, 2016 lows, major lows. 2011 lows, okay? So a lot of these major bottoms we've seen throughout over the years, we're there on this overall. Okay, so that you may just need to see that and nothing else if you're looking at it. I think the beauty of this DB update, they break down everything. Okay, systematic positioning. If you remember, we talked about how they were aggressively long and they just flipped short, but that's good. That's a lot better than where we were. But usually in a correction, they end up getting to a max short stage, right? So they get to a point where they can't short anymore, right? And what they're more inclined to do into any additional weakness, they're more inclined to do some buying rather than adding shorts, right? Where they were coming into this pullback is each and every time the S&P broke a level to the downside or VIX broke a level to the upside, they had to take down their long exposure no matter what. Okay, and you can see how, especially as big as these systematic funds are these days, how that can add to some, snowball downside, right? That violent move to the downside, or more supply just coming to the market. Okay, and that's what we've had to deal with. So now that's kind of on the back burner here, right? You can put a check mark there because they're as close, pretty much max short in most models. And if you get a gap down on some news and the market's down 2%, they're more inclined to cover some of that short exposure than add any more. Here are vol control funds. You remember we talked about them. They were stuck up here, felt like forever, literally, a year? And that's a pretty significant washout, right? Chart tells you all there is. Here's the COVID crash. And here they make the point I just made. Equity exposure for vol control funds is now so low, we estimate that even in a sell-off of under 3%, they will buy equities as opposed to sell equities like they have. CTAs, right? More trend-following crowd, systematic trend-following crowd. You're probably here dance in and out of that max short area until we start to, form an uptrend here. They can linger. They can linger down here, but just like they linger on the upside, max long, they try to catch trends. Okay, but I think the main takeaway here is that big piece of selling we were seeing from that crowd is over, right? And now on the flip side, if you start to build some momentum in the other direction, they start to unwind that short exposure. And that adds to the tailwind on the upside. What else we got here? Some of I'll get to the things that are missing here, but let me see. Anything else on here that looked interesting? Let's go to the systematic funds. I did that. Yeah. Hold on. All right, so here's kind of everything they measure here in the indicator. Here's across the board like systematic funds, right? So vol, we kind of looked at this though. Here's CTAs. CTAs across the board. I want to see futures here. I'm better off just showing you. Here's the survey measures. This is already was there. If you remember, a lot of the perma bulls were kind of holding on to this early on in this pullback. If you remember, when AAII sentiment was wild, thinking because AAII sentiment was washed out, the market couldn't go any lower. This is just as low as it was, if not worse. All right, so this has been here. Let me see. I want to show you options metrics. This is a little delayed. Some of the other things I pay attention to, retail put to call, retail opening activity, all have flash bull signals over the past week. This is as of April 4th, so it's a week delay on this. Okay, the next update, you'll probably see this thing at 0. And again, you look prior corrections. That's where it's been. Look at total net call volume. Just flush down the toilet bowl there. Look at that. Okay. Yeah, I don't know. Some of you guys may be dorky like myself and like to look at this stuff. Or, you just want to, you come on here to just get the basic, the takeaway. And like I said, the stuff that I was preaching patience about in allowing these things to set up, because in all likelihood they would in corrections, are there. Okay, here are the two aspects of positioning flows that are missing. One is fund flows, equity fund flows, the passive fund flows. A lot of, not always, but many times you will see a form of capitulation, right? Major outflows from some of the more passive investors out there. Those are usually the last, because those are longer term retail players in the sense, right? Conservative. They're going into equity funds more so than trading in the market. They have longer term time perspective on things. So you don't need a major wash out there, but what you're likely to see, you see a week or two of some pretty aggressive outflows. We haven't seen that yet. So, but that, again, that doesn't even need further weakness. You could see that in a flat, choppy market. I wouldn't be surprised we see that in one of the, we may see a update. Okay. So that's one thing that's missing. The other thing that's missing, that obviously, and many of you who know me and are in the steam room would agree, is in futures positioning. Okay. Now, there has been a ton of good, a lot of improvement in futures positioning. Okay. But what we haven't seen yet, we haven't seen commercial hedgers. This is not updated. I could post the. Okay, it's a little higher in here. So this is we refer to them as Sharpies, right? Commercial hedgers in S&P 500 futures. And just for those of you who are not too familiar with this, was the way they treat the game when a rally and when positioning and sentiment gets long in the tooth, their goal is to be max hedged. Okay? Example, late 2021, when after all GameStop and SPAC and breath is awful and the market's still chugging higher, people thinking there'll never be a pullback ever again, right? Sound familiar? We just went through that. They almost always will be max hedged. Okay, they will be hedged and not concerned about any additional upside when a rally, a bull market's long in the tooth and sentiment positioning is flashing heat like that. Okay, and they will be early. They don't mind being early. Okay, because again, they're not treating the game the way we are. They're dealers, right? A lot of times, especially in some of these commodities and stuff, these are people who are in that business, right? Hedging the price of oil and copper and stuff like that. Okay, so the big takeaway, the big signals are when they're max hedged, because that tells you a lot about sentiment, positioning, and where a rally has come to. Okay. And on the flip side is even more so when they take those hedges off. Okay. Because their goal primarily is to hedge. Now, the only times they take those hedges off is when sentiment, positioning, or correction gets overdone to the point where nobody's long anymore. Okay? And that's where they'll take the other side. So you can see here, right? Into the start of the 2022 bear market, they were max hedged, right? And you can see they started that a little earlier in the process at the end of the year. And then as the market pulled back, okay, they took off those hedges, got to a neutral state, and then took it to another level. Things got so overdone, more so on the sentiment side, positioning side, okay? So overdone now to the other side that not only did they take those hedges off, they aggressively put on long exposure, okay? And you can see how that stands out, right? It sticks out like a sore thumb here into the summer of 2022. Okay? So this is as of last week's update. We got another update Monday. We are basically at the zero mark here. Okay? So they took off their hedges, right? They had an aggressive hedge coming into the pullback. They've covered that. Now, the next step here for a bullish signal would be them aggressively putting on long exposure. Okay? So that's kind of the other thing that's missing out of this correction that we, as far as the things we look at. Okay? But again, this can happen. You don't need any additional weakness for this to show up. It can show up in an up week, a down week, my neck, sideways week, right? They already covered their hedges. That was the more important part, to get that process started. And now, like I said, even if we're stuck here, range bound, there's some sort of floor in, but the excitement to the upside or a new bull trend is what we're waiting on. Um, this would tip us off to that possibly getting started a lot earlier than we thought. Okay, so again, I talk for myself, right, and what I'm doing, and to the point I made earlier, I'm looking for stuff to kind of buy on a longer term basis. Okay, stuff that I like, stuff that I'm more interested in. What would give me a real kick in the rear end? One would be the sweeper activity. Okay, so if we do see some aggressive leap buying that really sticks out, it will likely force me into building positions in whatever name that is. Okay, again, example, COVID. You had the COVID crash. We were in lockdown. I thought we were all eventually going to turn into zombies. I thought the world was over. I certainly wasn't too interested in getting long equities into a global economic shutdown and pandemic. Sharpies flipped long. Is it on here? Yeah, here. All right. So Sharpies flipped long a little after we bottomed, I think a week or two after the exact bottom. And at that same time, we started to see a really aggressive, longer term buying in names like McDonald's, Home Depot, and a variety of other names, some more speculative, but it really stood out. Okay, so I didn't have any going in. I didn't have any intentions of buying Home Depot or McDonald's calls, but I did. So the sweeper activity is going to guide me not only how aggressive I want to be, but also be to generate ideas. Right? I guess I'm what I'm trying to say here. Okay. So without that, if we don't see sweeper activity getting aggressive, and we're seeing a little bit, I would say a little bit of improvement. There's some really, 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 really selective buying out there. But if it remains like this, because I get this question a lot, me personally, I'm not going to go out and just buy any name out there. You know what I mean? Because I have no interest. Like, I'm not interested in buying Microsoft because it's down off its highs. I have no interest in buying, I don't know, put in whatever, Tesla or whatever favorite name you may have. Okay? I've been there and done that. And honestly, I really didn't find much edge off of that. To be quite honest, I wasn't really too good at it. I'm not going to lie to you. Okay? I think the problem that I would run into a lot of times was you never know what the other side of that correction is going to look like. Okay? Some of those names may be dead money for a while. I know blasphemy to some of you, but it's very possible that new leaders end up leading the next bull phase whenever it shows up. And the last thing I want to do is buy a name I have no interest in just because everybody else is interested in it and it's down from the highs. Okay? So there's a reason why I try to rely on the sweeper activity. Another thing too is, I am more speculative in nature, right? I like smaller mid cap names, but basically same idea. I'm not going to go out there and just pick my own names because I don't know when they're going to get noticed. You know what I mean? I don't know when they're going to get noticed. See, the sweeper activity has spoiled me to the tune of where, to the timing aspect, right? I know there are other eyeballs more important than mine on that name. They may see what I like in that name as well, right? And when I say they, I'm talking about institutions. Okay, so it increases the odds that the street notices what you like about that name, or it being a potential new leader in a new bull phase, than it was prior to that sweeper, aggressive sweeper activity showing up. Okay, because I don't know about you guys, but I'm not a big fan of sitting in dead money, especially if there's a new bull market in here. One of the most frustrating things that you can possibly do, in my opinion, is you're sitting in a stock that's not participating in a new bull phase. Okay? Think about that for a second. You sidestepped the correction. You had the luxury of being in cash, so you had the ammo to fire, but you ended up buying names that didn't participate in that next leg up when it showed up. How frustrating would that be? And if you think, oh, well, not me, I know what I'm doing, I look at the fundamentals and the technicals and the whole shebang-a-bang, you got another thing coming, right? We saw it with the bull market, the COVID bull market darlings, the hockey sticks, as we were calling them, right? You saw people die on the island of PLTR for what? A year, 2 years before that thing eventually woke up? You think people held it for a year and a half of doing nothing while things were ripping all over the place and then felt rewarded after that? No fucking way. All right. So I'm just giving you the reasons why I try to stay patient and wait for the sweeper activity. That's one. I think even the more important thing, the sweeper activity, is that if they're not aggressively buying, right? If institutions are not aggressively, if we're not seeing their footprints in the order flow, in the options flow, there's probably a reason why. Okay? Now, again, positioning may be nicely washed out, sentiment may be nicely washed out, but maybe, again, the upside or that new bull phase in what we're looking for is not ready yet. Okay? So, these are the things I feel that where sweeper activity can help you out, help navigate. Now, you don't necessarily have to focus on just names that you're seeing aggressive sweeper activity in. I mean, example, to state the obvious, if you're seeing aggressive sweeper activity in a handful of semis and you like a semi that's in that group, right? I mean, there's no reason you can't buy that semi. So, but I definitely want to see signs. I want to see signs of an appetite in the sweeper activity for me to start to accelerate things in a sense on the buy side. All right, but as of now, like if it is right as it is, I don't mind. I don't mind this either, because the only way that I ever get my hands on any sort of weight, meaning I can build positions with time, is if we have a period where you get kind of a range bound market before an upcycle, before a leg up. You have an opportunity to take your time and pay attention to the flow and pick and choose which names you want to buy, wait for down days, for better prices, right? That's a luxury to have. You don't always have that luxury. So I don't necessarily mind if we hang around here and set up that way. Okay? Again, there's no guarantee that they end up sweeping the names I end up liking or want them to sweep whenever it shows up, but I don't mind it. Again, think here, and I know some of you heard it. It's worth repeating because you see people out there, especially on social media, who are clueless. Um, I mean, they're in the game a year, so I don't know how full of clues they're going to be. But in 2022, okay, where'd I go? Right, and I'm just using 2022 just because it was a good example of it. Right, so it's something fresh in a lot of your memory here. Okay. Again, to repeat what my feeling was, this, in my opinion, off what we look at, sentiment positioning wise, this was the low. Okay, now yes, it was breached in the fall slightly. Okay, but what I'm trying to tell you guys is what we're seeing now. What I've just shown you guys on the positioning side of things now is what we were seeing in the 2022. Okay? That's the point I'm trying to make. But very similar to, again, just a small sample size now, but to what I'm explaining is we really didn't see any good looking, aggressive sweeper activity in names that we would get excited about. Off the lows in June of 2022, or even off the lows in the fall. Right? And we talked about this last week, if you remember. The good-looking sweeper activity, especially in the names you guys like, the big tech names, the semis, all that stuff, that didn't show up till 2023, like towards the end of the first quarter of 2023. So, you had, even with kind of the lows in and a floor in, you had kind of a range-bound market, for multiple months before the Fed and Yellen had to implement that QE, not QE, and kind of grease the spigots, right, to get things going on the upside and get the excitement. AI, nobody gave a rat's ass about AI in late 2022. Okay? Nobody. You had the AI spec names, they would pop for a day and they'd sell them off so quick, they didn't know what hit them. There was no bid in these things. Right? AI really didn't kick into gear until we got into, I think it was late first quarter 2023. It was after that regional banking crisis, if I remember it correctly. Yeah, no doubt, Sahil. Everything that's what I'm saying. What we have seen showed up at major corrective lows is what we're seeing now. Plain and simple. Again, the only thing missing is Sharpies getting aggressive. Right? That's the only thing. The only thing. I mean, I just showed you guys. Like anything you want to look at, every major correction that we've had, lows, is what we're seeing now. Oh, my neck. I'm going to chop my head off this weekend, by the way. Okay? I'm going to just chop my whole head off from the neck up. Yeah, here, look. Here's the summer of 2022. And we're here now. Right? And again, it's not just that. It's every key indicator every key positioning indicator that I follow. Not only that, even breadth, some of the internals stuff that I look at. Is that washed out? You got things like stocks, the universe of stocks, percentage of stocks in a bear market at readings you wouldn't believe. Let me see if I can dig it up. Oh, God, that hurt. Hold on. Well, here, I got this one here I was looking at earlier. So these are major sectors in a correction. Okay? This is what this is showing from Sentiment Trader. Oh, God, man. I can't even move, man. I can't even move. I make one wrong move, and I'm in agony. Okay? So this is major sector percentages in a correction. Here's the 2022 summer lows. Here's the fall lows. Here's COVID. Here's late 2018. Here's Volmageddon. Here's 2015, 2016. And it's not just one. I'm telling you that's the change that we were talking about last Sunday. That's the major change in tune you're hearing from me, is that we are there. You know what I mean? We are there. Again, the things that are missing are more so not necessarily for a floor being put in, but more so of a rebound. You know, Sharpies, fund flows too, but fund flows, if I remember correctly, I don't think fund flows were that washed out in 2022 either. But I would like to see that, no doubt. Let me see. Hold on a second. I got where's another one here? I mean, panic euphoria model. Yeah, you even got some put the call readings, certain put the call readings back at 2022 lows. Let's see what else. Where's that bear market one? I wanted to show you this. This is hold on. I can't move quickly here. So this is like measures major pessimism. All right. So kind of everybody all gloomed out. Now, and you can see like 2008 was the apocalypse. And you got to understand, right? Like 2008 was the guinea pig. We let Lehman fail. Ever since we let Lehman fail, the Fed has always been there. Right? That's the reason. Lehman was the guinea pig. They tried to let free markets work. It almost took the whole enchilada down. Okay? So if you think Powell has a personal thing against Trump and he's willing to punt the whole U.S. economy for it, then that's a different story. What I would tell you is buy gold, go hide in your bunker, and don't come out. Right? But so here's like even 2008, when you got some of the readings we're seeing now. Even in 2008, you had bear market rallies that were stronger than bull markets. I think that's what people don't realize. In that downturn in 2008, you had a bull market every 2 days. Literally, every 2 days. You had a rally like you've never seen in your life before. You know? So you could kind of make it out on this thing. You could see every time this thing got elevated, you kind of had, right, a little bend, a little floor put in. Okay? Here's another thing that we looked at on the members only. Well, we have been looking at on the members only Sunday webinar. By the way, no members only Sunday webinar because Jesus has risen Sunday. Here's something else that really spooked me before the correction. Really did not make me feel good about holding anything that has played out here nice. Hold on. Let me try to zoom in. So this is the correlation component indicator we've been talking about. I think I talked about it many times on this Thursday webinar. I know we talked about it in the room. You know, we've been hanging down here for a while, and you know, it's just you do not want to get aggressively long with this thing down here. You're asking for it's suicide mission. It's playing musical chairs. You know, you may get away with it for a little bit longer than I think you would, but you get caught in it, you're dead. You're dead. All right? On the flip side, there's no better. It's a sweet spot entry after this thing unwinds, gets elevated, and then eventually tops out and rolls over. Right? So we're talking here, we're talking here, you're talking here, 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 and that's going all the way back to 2009 lows. Okay? Now, what you may see is this continue to elevate over the next couple of weeks as we do what we're doing with it, which is, I don't know what you call it. Chop? What do you call it? Certainly isn't bearish. You know? But, oh yeah, Sahil, I'm miserable. It's the worst pain in the world. I can't, every little move I make the wrong way, I get electrocuted. That type of pain. It's unbelievable. Miserable. Put you in the worst mood too. So again, down here, this thing was lingering down here even as the market started to roll over and correct. Right? And if you remember, on these webinars, people would ask, all right, the market has pulled back now, 5% off the highs. Is it now the time? And with this still down here, felt like the market didn't pull back at all. Like I'm not going to build positions over the intermediate term with this thing hanging out down here. I'm just not going to do it. So now, thanks to Liberation Day, this is nicely elevated here. And eventually, right? If you look back, it's usually with the help of the Fed that gets this thing to roll over aggressively. Once the cavalry shows up. Now, I don't want to get into the macro side of things, the economics, but I mean, Powell can say whatever he wants. I get it why he don't want to be too early. It won't benefit him, I guess, if he ends up being wrong by being early. He gets away with being late and being wrong, I guess. But the Fed's always looking at old data and reacting off of it. And you got financial conditions which have tightened up pretty aggressively here. You got the bond market. I wouldn't call it cracks, but there's some concerns starting to arise. If the market wants Powell, it's going to get Powell. You know what I mean? It's going to get Powell. It's only a matter of when it wants to, right? And it's only a matter of when. And I would say the bond market even more so than the equity market. So the risk here is that the Fed is late. That certainly is a risk here. Okay? And that's maybe possibly why sweepers are not excited and not getting aggressive. Right? I mean, they're not even playing bounces aggressively. So it could be they're concerned about the Fed being late. But that's why still I think what we're using this setup as looking for constructive signs, looking for opportunities that we want to piece in to longer term. Okay, because you're going to understand something. Once the cavalry shows up, there's a good chance that you're going to see things speed up rather quickly. You know what I mean? And then you're going to complain that you didn't have any time. The beauty, I think, of a lot of the signals we pay attention to is that it allows you to be on the earlier side if you're looking to do that. So even though I think the Fed being late is certainly a risk, one, I think positioning is in a much better place here, so you don't have the same supply to hit the market. But two, as much as Powell is singing a completely different tune than what you would want to hear from him, I think he's well aware of where things are at. He's not a dumb man, right? So you got like credit default swaps in the fours. When they get into that 5 area, Powell's beeper goes bananas. You know what I mean? So if things start to snap and credit default swaps widen out a bit more than where they are now, the Fed has no choice but to get involved. Okay? So, again, then, depending on what they do, even a Fed measure doesn't necessarily mean this violent move to the upside, because they could take certain measures, right? Doesn't have to be all out version of QE, probably won't. Doesn't necessarily have to be rate cuts, but the main thing is you have to pay attention, because if you don't, you will miss it. And I'll give you an example, and then I'll talk names quickly and let you guys enjoy your long weekend. The SIVB crisis. Okay, so think of this now. We bottomed in 2022, right? We bottomed in 2022. Now we've been range bound going into 2023. Okay, think about the noise out there. And this is what I told you guys last time, and I reiterated Sunday for members. The one thing you need to, I think, be aware of is that what's likely to happen is the news, the noise, as we say, continues to get worse, right? It continues to get more bearish. And if you're paying attention to the noise and getting wrapped up in the conversation and the arguments that you see on social media, okay, you're going to end up scaring the shit out of yourself to pulling the trigger no matter what, even being cash and ready. And you won't be able to pick up on the signals telling you otherwise. So the point I'm making is 2022, we bottomed, we had a floor put in, and we were just range bound. Why? Because the Fed was still tight, right? They were battling inflation. Okay? So in October, when the Fed pivoted, they stopped tightening because the bond market, the credit markets overseas were cracking. The UK gilt market was snapping, right? So the Fed had to take their foot off the brake. Now, they didn't turn on the spigots, but they took their foot off their brake, right? Then you had SIVB occur and the regional banking crisis. And what was the noise then? Oh, they can't bail out regional banks. They're never going to bail out those regional banks. No way will they get away with that. Then you got these cockamamie banking facilities that they implemented and all this shit, pumping more liquidity into the system. Bitcoin started to take off. Credit default swaps started to tighten, and credit spreads starting to tighten aggressively, all signaling a Fed pivot. Okay? So you had a range bound market for a couple months here, and the bearish noise continued to build. Remember, 2023 was going to be the year of the recession. Everybody's 2023 target for the market, the S&P 500, was down. One of the first times ever. Everybody had a negative year predicted. Crazy shit, right? You had Druckenmiller, who's the sharpest guy in the game, talking about a range-bound market for the next decade. Right? And that all could have been true. We probably would have seen a recession. We probably would have been in a lost decade if you didn't have the Fed get involved. You know? So you don't, as much as it's fun to talk about, and I love following it, I love talking about it, but a lot of times when we get into this type of environment, I try to push myself away from getting too wrapped up in the day conversations and arguments, debates, because when you're focused on that, there's a very good chance you miss the more important thing that may show up. Yeah. Inflation, the issue. You got, deflationary signs all over the place right now. Now, listen, I get it anyway, right? He's looking at old data, and they'd rather be a little late than be early and wrong. I get it. But if he don't want to go that route and cut rates, he's going to have to put fires out, because they're likely going to be fires that show up because shit's just too tight right now. I mean, financial conditions have tightened up rather aggressively. Rather aggressively. So I think that's the main takeaway, is that the news is not going to start. I'd be shocked if the news gets better from here. Okay? I think the news gets worse. But what makes me bullish now, in where I was cautious for, in my time frame, a lengthy period of time, is that players and funds are positioned for negativity where they weren't coming into this year. Right? And we talked about that. The end of last year, it was like Jesus Christ was going to be president of the United States, not Donald Trump. Like, they were pricing in all the good of Trump and didn't even stop to think about the negative aspect of Trump for markets and everything else. Like, we didn't deal with it once before. Like, he was never president of this country. Right? But sentiment got so out of control to the bullish side that they just were pricing in all good and no bad. Right? And now what I think we've seen is players now and funds are positioned for no good. No good. And that's the big difference. I don't know if you guys seen the Bova Fund Manager Survey. Have you guys seen that came out this week? They're suicidal. Fund managers, absolutely suicidal. Down here, record number of fund managers, global investors intend to cut U.S. equities. Look, I mean, we went from all you want to own is the U.S., nothing else. Remember Europe, the outflows in Europe? Guys, if you don't think sentiment and positioning is the most important thing out there, I don't know what more proof you need to see. Okay? This here, all right? DAX. Okay? Do you guys remember going into 2023 what the sentiment was like going into for Europe going into 2023. I heard people talking about Germany. They're going to need to burn things to start fire because they're not going to have any heat. That's how bad it's going to be. Apocalyptic. The fund flows for Europe literally were so bad it looked like everybody that had any exposure to Europe cut it. There was nobody who had exposure to Europe anymore and Germany. Okay? That was right here, my friends. Now, you tell me, and I don't know, I don't follow the German economy, right? So I don't know what's going on there. But you tell me what happened that's been so good and bullish for Germany for this to happen. Can somebody explain that to me? You know, can somebody explain that to me? Remember they were going to freeze in Germany. Look at what this DAX did. Now, if you ask me, I think because nobody owned the DAX. You talk about capitulation. You've seen capitulation in Germany like you would never see before. Literally looked like nobody had any exposure left. But I mean, again, whatever reasons you're hearing now that may be positive, and I still don't hear. Yeah, the fiscal spending is now recently, right? That just happened. I mean, look at this move. You know, it's in both. When everything is bullish and everybody knows why it's bullish and everybody owns it because it's bullish, it's not bullish anymore. You know, if everybody already bought, they already own it, they already like it. Where's the risk reward in that? And on the flip side, when it's bearish and we all know it's bearish and we're all positioned like it's bearish, that's a sweet spot, my friends. So that's the story. That's the story. All right, very quickly, flow wise, it's been quiet, like I said. Couple names we've seen some buying in here and there. I own a little of this K-View. I mean, I don't mind adding to it too. You know, it's not a name that's going to excite you. It's kind of why I haven't added to it anymore to it. But looks good, really good. One name they started nibbling at December's is this Byrne, Byrn. Again, they've been mostly a lot of just, I call it nibbles. No, one round of buying, you know, one round of buying. But that's it as far as under the radar type names that I like. As far as big names are concerned, Costco, there's been a couple decent sweeps in COST. Not much of a pullback at all there either. Look at this. Caught a July sweep and then caught another sweep today. Some names, you know, a few leap bets here and there. And nothing that's getting me jumping out of my chair with my stiff neck and excited. But, you know, we'll see. Now we got earnings season here, so we're going to have some more information to digest, right? Maybe we'll see some pockets of leadership coming out of there. What else? They started buying a few of the energy names again, like an ET, EQT. You know, these are repeat names that have seen steady buying on dips. Next, you know, but Again, nothing that stands out, right? I promise there will be buying that whether I like the name or not, I will be forced to talk to you guys about it because of how aggressive the buying. You know, that's the flow that usually shows up, especially after what we just dealt with here. You know, pull back like this. So again, I feel I'm definitely a lot more bullish than I was. You guys could probably tell. I know you guys have mentioned you could tell it in my tone alone. And I'm just, I'm just waiting on some evidence, some clues of what the hell to get long here. And I don't mind some time to do so. I really don't, because I'm talking for myself here. For me to put on any sort of weight, right? For me to get my hands on positions, I'm going to need time, because you guys know I hate chasing. So once things start to run away from me, I'm less inclined to chase. You know what I mean? But there's no reason to have that FOMO here now. There's no FOMO in me. You know what I mean? There's no FOMO, because when the true turn shows up and there's new pockets of leadership and there's healthy flow, there's more than enough opportunities, man. More than enough. Think of, again, not any bull market, but even just a bull run for a 4-month stretch, 3-4 month stretch. Think of all the names that get littered with sweeper activity, right? All the names that get aggressively bought, the moves in some of those names, and you never run out of opportunities. Now, don't get me wrong. I think the problem comes in is the first few that see that buying are usually end up the biggest winners. That's how it usually goes. So you want this, the obvious reasons you want to try to own those. So that's why you got to pay attention. But I wouldn't get too antsy. There's no reason to get too antsy. And there'll be pockets of subsectors that see momentum buying, right? Like the space names, like the Bitcoin miner names we've seen, all those things. We're seeing a little version of it. You're seeing it in the rare earth mineral names, right? It's a spec pocket. So there'll be plenty of that. Those things usually come about from when the Fed sprinkles liquidity. That's where those things usually show up. But again, I feel a lot better for obvious reasons. And this is kind of like this here, right? Think of me as this chart right here. Okay. Hold on. That would be quicker. Okay. This is me coming on here cautious, talking about bunkers and jarred and all that fun stuff, right? When this is down here. And when this gets up into this neck of the woods, I'm skipping around, walking a little bit taller. So that's kind of where things stand. All right? My friends, have a happy Easter. Make sure you repent. Acknowledge Christ is King, so you make it to the other side. And I will see you. No webinar. I told you no webinar Sunday. So I will see you guys Monday when we get back. All right? Yep. To you guys as well. Enjoy the long weekend. Rest up. And I'll see you guys early next week. Later, everybody.